Hello everyone and welcome back to Our Trades. It is time for a back to basics video where we're going to talk about the basics of support and resistance, the number one goal as a day trader in technical analysis. We're going to go back to fundamentals 101, support and resistance, trend lines, breaks, continuation, and what the number one objective is as a day trader, what your number one objective trading directionally is. Before we get into it, guys, my name is Reese. I run this channel here called Our Trades. I'm a criminal defense attorney in South Texas. If you are in the South Texas area for any reason and you're facing criminal charges, please feel free to reach out. I can assist you. Guys, I am not a financial advisor, and this is not financial advice. What you are about to see is the opinion of an amateur. Okay, so what does that mean? That means contact a licensed financial advisor if you want professional advice. I am not responsible for your decisions. Trading involves substantial risk of loss, including the loss of your initial capital and any money that you put in after it, guys. Also, I am a prop firm trader. All right, prop firms are companies that offer challenge and simulated accounts where you can, if you follow certain rules, take out real money payouts. They are generally a whole lot cheaper to use than funding your own brokerage account. That being said, you still need to be responsible with them and don't reset them 30 times a day. Guys, I currently trade with Apex Trader Funding, Top Step, and Tradeify, all on their simulated accounts. I'm an affiliate of Apex Trader Funding. If you are interested in trading with Apex Trader Funding, please make sure to enter coupon code RTRADES, that's all one word, RTRADES, into your purchase box, or use my affiliate link in the description box below if you want to support this channel, support me. Okay, guys, all of that out of the way, let's talk about what is your number one objective when you are day trading. What is your number one objective? Guys, your number one objective is to ascertain the trend for the day, the trend for the week, the trend for the month. But primarily as an intraday trader, you're trying to find out what the primary trend is for that day. Okay. The way that you do that, guys, is you go back to fundamentals. The way that the market works is that it has inertia. When it's moving in one direction, it will tend to trend. It will tend to move in that same direction. If you've ever watched technical analysts on CNBC, MSNBC, Bloomberg, or online, you will oftentimes hear them say, if the market breaks this level, then I expect that the market will continue to go to the next level. If the market breaks this level, then I expect that it will continue to travel in that same direction and go to the next level. All right, that is the basics of technical analysis, is that the market trends and that it tends to move in the same direction that it's already been moving. So let's take an example of that, guys. We're here on the daily chart of the micro NASDAQ. This is going to be true for any financial market that you're looking at. We could also look at gold, crude oil, or the S&P 500 or any individual stock as well. The market tends to trend. Your objective is to figure out what is the trend for this session, what is the trend for this day. If you're day trading U.S. stock index futures, which is what I do for the most part, you need to figure out, there's kind of two basic trends that you need to figure out. What is the overnight trend and what is the regular trading hours or the open market trend? They can be in the same direction or they could be in opposite directions. All right. Again, the basic idea is the overnight session from when Asia, London, and the U.S. pre-market. These things oftentimes have a different trend than the U.S. regular stock market trend. Okay, guys. Also, a basic concept is that the higher the time frame, the more significant the trend. So, for example, weekly trends are more important or more long-lasting than daily trends. Monthly trends are more important and more long-lasting, more persistent than weekly trends, and so on and so forth. The chart that I'm going to start you out with as an example here is the micro NASDAQ, and we're going to talk about from 2023 to 2024 when the market was moving higher, and I'm going to show you how this basic idea works using horizontal trend lines, okay? So what I'm going to do is I'm going to set a series of horizontal trend lines, and I'm going to talk about how you can analyze the market using just simple horizontal lines, and the concept of the trend will continue. Okay, guys, so let's say that we're down here after the market reverses. Again, the market sometimes does reverse, guys, but it is more often that the market will continue than it will reverse. Okay, that's not to say that reversals don't happen. That is to say that the majority of the time, or greater than 50% of the time, the market, when it breaks through a level, it's going to continue. All right. But reversals obviously do happen. Okay, guys, so if we're analyzing the market, let's say that we're sitting down anywhere from Thursday, the 26th of October, up until Thursday, the 9th of November. There are a few different levels of resistance, resistance being where price has failed to go higher in the past. Okay, that's the basic concept of resistance, is where price has failed to have gone higher in the past. And we're going to assume we're going to talk about the basics of how you describe price action and how you predict where the market's going to go. Okay, and you're going to hear this from technical analysts all the time. All right, first obvious level of resistance was at 16,922 quarters. Okay, and that was formed on a high formed on Thursday, 12 October. Anytime when we hit the low from Thursday up into Friday, as the market went higher, technical analysts would say something to the effect of 16,922 is an important level. I think that if the market breaks 16,922, that we're likely to go and challenge, or we're likely to move to our next level of resistance, which was at 17,312. That's kind of how you describe the market, is if it breaks this level, then I expect that it will go and challenge the next level. This brings me into the next discussion, which is standard deviation projections. What are standard deviation projections? Standard deviation projections are where you take the move of a swing and then you project that same length higher. Okay, you can do this easily on TradingView. Okay. All right. So I know this can be a little bit difficult to see on the screen, but basically what I've done is I've applied a Fibonacci from the low of the move to the high of the move just before the market moved past that resistance. And that same distance, you'll notice, so that move from trough to peak was 1,316 points. If I take that from where the market broke, notice that that's the same distance to the next level. So that's a standard deviation projection. That's basically saying, I think that if the market breaks this level, it is likely to continue in the same direction by half of the previous move, by 1 times the previous move, or exactly, double the previous move, or twice the previous move. So we can see that the market, when it was in its bull market phase, ended up moving beyond 2 standard deviations of the move. But one thing that you can kind of see is that the market at a half deviation had a half deviation higher, kind of had a reaction off of that level. Similarly, it had a somewhat of a reaction off of 1 full standard deviation, and ultimately it had another reaction off of the second standard deviation as well. So you can see that the market typically kind of moves in these organized moves. But that's the basic idea when the market is trending. If it breaks this level, I think it's going to this level. If it breaks this level, all right, 17,567 halves, it breaks that level, all right, closes above that level, I think it's going to move on to the next level of resistance. And that's exactly what the market does. So when the market is strongly trending, this is how you predict where the market's going to go. If it breaks resistance, all right, let's get to our next example. I'm going to take our horizontal line tool, and we had resistance at 18,405.75. And when the market moved higher, all right, same thing here. We're going to use our standard deviation projection. We can see that the market moved 1 standard deviation higher, 1.5 standard deviations higher. The idea is that if the market moves beyond this level, I expect at some point the market will continue to go to the next level. And that's how you look at a trending market. Let's look at another example here. After the market had a pullback, as the market moved higher, we had a clear level of resistance of around 19,704. When the market broke above that level, you see we had somewhat of a pullback the next couple of days. And again, we moved higher. Okay. And we moved just above 1 standard deviation higher from trough to peak. All right. So the same concept works when you are trending down. So let's use an example of our most recent downtrend. The first thing that you want to do is you want to look for key levels of support. What is support? Support is generally a price point where the market does not tend to want to go lower. These are basically where the market has turned around in the past and moved higher. Okay? You can see that we had a level of support at 20,975. A technical analyst would say that's an important level of support. If that level of support, uh, if that level of support is broken, I expect that we will likely move at least down to the next level of support, which was 2,513, which we did. And the technical analyst might then go on to say it's possible we go and make a run on our next level of support, which was our low that we made on the 6th of September, which the market did ultimately come down and break through that level of support. And we just keep moving down the same way. So let's say we had another level of support at a low at 18,081. The technical analyst would say, okay, if the market breaks through that, it is more likely than not that we're going to move down to our next level of support, which is at 15,589. And it's the same thing as we move lower. Now, the market has pulled back, and so the market appears that it may be reversing, but that's not really the crux of this video. The point is, yes, the market does reverse. The market obviously reverses. The point is, this is how you describe trends, assuming that trends remain in place. All right, let's go down to a 15-minute chart and let's show you how this would work on an intraday example. Okay, and I want to take a nice, strong trending day, and I'm going to take it from including the overnight session. I'm going to take it, let's see. All right, we're going to take it from that Monday up into that Tuesday. Okay, we're going to talk about how you can use this concept in an intraday setting. Okay, so just using the price action that I've outlined here. All right, let's say that we're sitting somewhere in the middle here while the market was ranging. We were first looking for our levels of resistance as the market was moving higher. So our first level of resistance was somewhere, let me use a horizontal line. So okay, we had a first level of resistance at 17,885. The technical analyst would look at this and say, if the market breaks that resistance on a 15-minute level, I expect that the market will go and challenge and potentially break through our next level of resistance, which was at 18,360. You can see that the market broke through in the pre-market at 0730 New York local time, and it in fact did go and challenge the next level of resistance, forming a double top. Okay, using our standard deviation projections, we can also see that the market moved from trough to peak 2 standard deviations higher. All right, that's the basic idea behind technical analysis. Whether you're trading ICT or whether you're trading any system that is out there, the idea is that the market, when it breaks through a level of support, it's likely to go down to the next level of support. When the market breaks a level of resistance, it's likely to go to the next level of resistance. When I say likely, I do not mean guaranteed. There are times where the market is going to reverse, and there are times where the market is going to change directions, or there are times where the market is going to remain in a trading range. However, a majority of the time, as a technical analyst and as a day trader, or as a trader, an active trader, you must assume that the market is going to continue to trend in the direction that it has been trending. If you do not assume that, you're going to be burned 60%, 70% of the time. You're going to be burned a majority of the time. All right. If you assume that the market's going to reverse rather than move in the same direction that it's been moving, you're going to get burned and eventually you're going to lose your money. All right. That's not to say that reversals don't happen. That's to say that the trend is your friend, and a majority of the time, the market is going to continue trending in the same direction. All right. So you want to wait until the market reverses strongly before you assume it's moving in the next direction. All right. So we had a reversal coming into the regular trading hour session on Tuesday, the 8th of April. All right. This is all over tariff news, and there are some macroeconomic factors, basically just tariffs, of why this happened, but I want to show you how you can analyze this from a technical perspective. So let's say that the market has now reversed and you've caught on that the primary trend in the regular trading hour session is down. Where would be our first level of support? Well, from an intraday point of view, we can see that the market formed a little bit of a pullback and support at 17,926. When the market moved through that, it moved to our next level of support, which was 17,668, which was a group of 3 lows. When the market moved through that, it moved down to our next level of support, which I would argue is at around 17,432, or this low here that we formed on Monday. When the market moved through that, it went down to the next level of support, 17,150. And you can see that there are reactions in and around these levels. Okay. When the market broke through that, it was going down, moving down to our next level support, which was 16,673. We can see that the market did try to make a run in Wednesday's overnight session down, but did move higher. Okay. Then the market comes into something of a trading range, or you could call this a reversal. So now, whenever you can see that the direction has changed from down to up, which doesn't happen instantly, and you continue betting all the way until the market makes this clear, this move higher, you're assuming that the market is probably still moving down. Okay. This is why trading is difficult. Trading's not easy. It can be difficult to ascertain what the primary trend is. But when it becomes clear that the market is trending in one direction or another, you need to move in that direction. All right, so let's move through Wednesday and then through Thursday's example. All right, so we see the first level of resistance as the market moves higher was at 17,204. A couple of our next levels of resistance, 17,426. Again, we're assuming that if the market breaks through one level of resistance, it's going to move to the next. So then we had our next level of resistance at 18,357. So a pretty substantial difference there, right? The market went straight down. When the market tends to go straight down, it tends to go straight back up. This is called the mirror principle. All right, so as the market came and broke through the first time, that resistance we had at 17,204, the market did not quite make it to our next level of resistance and pulled back. This is what can make trading difficult, frankly. All right, we moved again through that first level of resistance and moved again through our next local high. The market kind of drifted. And then when the tariff announcement, the easing off of tariff came out, we were up 7%. We blew past the next level of resistance. All right, next level of resistance, it's 18,357. Let's say that you're day trading and you're not certain what the next, you can't see immediately on the chart what the next level of resistance is. What are you going to do? Well, what you're going to do is you're going to take a standard deviation projection. You're going to take the move from trough to peak and project that higher. So from trough to peak, all right, a half standard deviation higher of that break above 18,357 takes us to 19,168.50, more or less kind of about where the market ended up reversing. As the market, then we see a market reversal in the overnight session on Wednesday. We're going to run through the same process with the levels that we could see. There was support here at 18,716. As the market came down, you can see that it did not break through on its first attempt. Then the market came down and broke through support on its second attempt. That's from this low here, this pullback on the way up. What are we going to do? We're going to assume that the market is going to move down to its next level of support. If you cannot immediately see from the candlesticks where the next level of support is, you're going to use a standard deviation projection. All right, the market breaks lower and it moves. So again, we're going to take this from peak to trough, 671 points. And as the market breaks lower, when you look at that, we move about 671 points lower before the market turns around. So be surprised how accurate these things can be. Okay. Coming into Friday session. Okay, Friday session. This is more difficult trading because it's not readily ascertainable what the trend is. That's what makes trading ranges difficult. You may need to go down onto a lower time frame to see support and resistance breaks, or you may just not want to trade when the market is not clearly moving. All right, in one defined direction or another. Let's go on Friday for Friday's trading action during the regular trading hour session. And let's use some of the principles that we've already learned here, which is the market breaks a level higher, we expect it to go to the next level. The market breaks lower, we expect it to go to the next level down. Okay? Assuming that you were on the right side, our first level of support was at 18,566. From trough, or the low point, to peak, we're going to take a standard deviation projection, and the market ends up moving first a half standard deviation higher pretty easily, and then a full standard deviation after a pullback. All right. As the market then breaks above our next level of support, okay, our next level of resistance was at 18,787. We're going to take peak, trough to peak, and assume that the market's going to move in that same amount higher. All right. The market moves about a half standard deviation higher, but ends up out in a trading range for the rest of the day. As we open up on Sunday, what am I expecting to happen? I'm expecting that because the market has recently broken a level of resistance, I'm expecting that the market is going to move higher, and I'm expecting that the market will at least move up to 18,980.75. If the market wants to move even higher than that, 1.5 standard deviations higher would take us to 19,077. 2 full standard deviations would take us up to 19,173.75. Again, guys, I'm assuming that the direction that the market came in is the same direction the market's going to go out. I'm not presuming that the market's going to make a reversal until the market definitively reverses. So because we've recently broken a level of resistance, I'm expecting that the market will move a standard deviation or 2 standard deviations higher. All right, guys, that's how you basically analyze a chart. Notice I didn't talk about fair value gaps. I didn't talk about ICT concepts that much, although you can use ICT concepts. That's the basic way that you analyze a trend, and that's the basic way that you analyze technically. The number one objective that you have as a day trader is ascertaining what the market is doing in terms of trend. ICT calls this daily bias. So if you are an ICT trader, if you're trading ICT concepts, he will talk about this all the time. But the most important thing is that you figure out what is the daily bias. If you are not familiar with ICT terms, if you're not familiar with what he's talking about prevailing trend. Is the market primarily moving down, or is the market primarily moving up in the time frame that you're looking at? All right. This is not always easy, but this is the basics. If the market breaks above a certain level of resistance, assume that the market is going to move to the next level of resistance. If the market moves down and breaks a level of support, assume that the market is going to move down to the next level of support, all the way down to 0 and all the way up to infinity, until such time that the market reverses and definitively shows you that it has changed directions. Higher time frame trends are more important than lower time frame trends. Monthly trends are more important and more persistent than weekly trends. Weekly trends are more important and more persistent than daily trends. Hourly trends, then 5-minute trends, 15-minute trends, then 5-minute trends, and so on and so forth. All right, guys, this has been Our Trades back here with another video on technical analysis basics and trend following. I hope that you have enjoyed it. I hope that you remember the number one takeaway from this video is what is the prevailing trend? What is the daily bias? In which direction do I expect that the market is going to be moving? As a directional trader, there is nothing more important than that. Not trading psychology, not emotions. Those things are all important. Risk management is also very important. But in my opinion, figuring out in which direction the market is primarily moving is the most important thing. All right, guys. I appreciate it. Thank you.